The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Hello everyone, and welcome back to Ausbiz Live from our Barangaroo studios. Great to have your company here on The Call. 10 stocks picked by you. I put them to our expert panel. We do this on the very last day of not only summer but also earnings season as well. Panel today, Rudi Filapek Vandyck from FN Arena. Rudi, are you exhausted after earnings season?
Yes, I'm completely caffeined up now.
Because the last day or two, you tend to get the stragglers often disappoint.
Yeah. Well, you get the small caps and you get the companies that can't wait any longer to bring out the bad news.
Yeah. You know what?
Moreland from Teaminvest.
Why a lot of the small ones don't report till the very end is because the auditors are all too busy with the big ones. They make a lot more money, and they don't get to the small ones until they've done all the others. So it's not their fault.
That's the reason.
Yeah.
Okay.
Absolutely.
Oh, that's interesting.
The rats are nice.
Yeah. All right. Let's take a look at the 5 stocks we're going to cover, or you want us to cover in this first half hour. TPG Telecom, Eagles Automotive, Treasury Wine Estates, Magellan Financial Group, and also Macquarie Group. That is a diverse bunch, isn't it? Stock of the day, I thought we'd have a look at Tyro with the panel. We'll be speaking with Chief Executive Jonathan Davey a bit later in the show. Tyro's reported a 45.2% jump in revenues for the half, delivered a 106% increase in statutory net profits. 1.1 million for the period returned to the company to profitability. It's off a low base. Also reported positive free cash flow for the first time. Tyro reaffirmed its full-year guidance of between $37 and $41 million. UBS has already upgraded it to a buy, with an upgraded price target of $1.95 from $1.64. Currently the stock barely moving, up 1%. Had a bit of a spurt early, but has settled down. Rudi, what did you think of the Tyro result, and also the stock at these levels?
Well, conclusion number one. Clearly, because if you combine it with, let's say, the disappointment by Harvey Norman today, so clearly consumer spending is a very wide basket.
Yeah.
At least you can say about the Tyro is that they've read the room last year, so they've cut costs, restructured, put a lot of initiatives in place, and as a result, much earlier than previously forecast, positive cash flow. That all should all else being equal, that should be a positive, of course. I'm still thinking that the company will need to convince the market here that the expected slowdown in consumer spending later in the year, how that's going to impact Tyro and how well they will manage that, if they can manage that.
Yep.
And I suspect that's the reason why the share price doesn't. Also, they have pre-reported the key numbers already, but I think the positive cash flow is, I think that's the big achievement, and that's what investors now want, because the whole environment has changed, where previously it was all about increasing your market share and getting new customers on board. Now it's about where's the cash and where are the profits.
And is it important to have confidence in a management team that actually delivers and delivers early on what they were promising?
Well, not every company can pull forward their profitability and their cash flow, so that's unmistakably a positive.
Right. Would you be buying at these levels?
Probably not.
Right. After all of that, probably not. Why?
Too many question marks for me still, and the share price is now well off its lows.
Right.
At the lows, you have a much better chance to end up positively. Here, the share price already has bounced a lot off the lows. Yes.
Okay. Mark? Hasn't been listed long.
No, it's only got 4 years, so it doesn't meet our requirements. But I know the business reasonably well, particularly in the early days when it was a payments processor, which was a very, very brave business to go into, because they actually went into it to compete with the big banks who controlled that market at a time we had deregulation. The deregulation didn't actually help Tyro. It enabled them to get into the market, but it meant that they fought with the, not just deregulation, it was the fact that the Reserve Bank dictated what interchange fees were going to be on credit cards, which meant that merchant fees got squeezed right down. So Tyro entered the market at the time where the fees the banks charged got massively reduced.
Yeah.
And you go, well, how's that work?
And a lot of the banks got out of the market as a
because
result
they
of
didn't
that,
make any money out of it.
Yeah,
It was more of a service to their business clients, really, than a major profit center for them. It was a bit of a pain in the ass. They make money out of credit cards, but that's on the lending side, on the issuing side. But as far as the merchant services have never been very lucrative. Anyway, that's where Tyro started, and you've got to give them kudos. They managed to survive, and they built it up and ultimately listed, and now they have, I believe, a full banking license, so they're a fully fledged bank. And they are the small guys in that area, and they're sort of the disruptors, because the technology they brought in originally with payments were that you could do multi-currency payments at the airport and stuff. They were the first ones to do that, which was good. So it was a staid old industry, and they've made some changes. So I'm sort of hopeful that they go on to succeed. But right now they've been losing money, for the last 4 years. Now they've come out with a positive statement that they're cash flow positive. Great. It's not a reason to buy it yet, but maybe in a couple of years, I'd be interested, perhaps.
Right. So it's on the right path, but not yet.
Yeah.
They've got to prove themselves.
And I hope they're successful.
Yeah.
Positive cash flow means they don't have to come to the market to raise cash.
Right.
And that's definitely a positive.
Yeah, and that's a good thing in this.
And the banking cycle's at the high end as well, which is not helpful.
And there sort of does seem to be a move by the bigger banks to get back into that payment system, because they can see it building a better relationship with their small business clients.
Well, I think the original idea, like if you were a CommBank business customer and you had everything with the bank, your overdraft and your mortgage and your credit cards and all that, and your payment, it's that having a full service relationship is a very powerful moat. And the more you let that get broken up, then you start getting weaker and weaker. And the big banks are really building societies.
CommBank is still doing this, huh?
Yeah, they are. But the others and the other big banks, they're all sort of building societies now, really.
Well, Westpac had a nibble at Tyro and then decided no.
That's right. All right. Our first stock, Kim wants a view, Mark, on TPG Telecom, one of the. You've got basically Telstra, Optus, and then TPG that sort of soaked up Hutchison and Vodafone and the like.
Yeah. I used to be a shareholder. It used to be a Teaminvest Wealth winner, and we really liked it. I actually did really well on it, so I'm happy. But I haven't been a shareholder since David Tyro left, because basically it was a founder-driven business. It was a very entrepreneurial culture. He was an absolutely excellent disruptor.
And he went to Tuas, didn't he?
Well, Tuas, yes, and that's in Singapore. And basically, he's thrown the towel in on Australia, and I don't blame him.
Right.
Because what he went through when they tried to. Well, first of all, they were going to disrupt the market with 5G using Huawei technology, and then the government blocked that. Okay, that's political. And that sort of killed their impetus, because they had a real lead on Telstra and Optus. So then they decided to merge with Vodafone, which made sense because Vodafone had a strong mobile business, and TPG was mainly broadband home. So it made total sense. But then the ACCC, the anti-competitive tribunal or whatever they call it, blocked it, and they basically killed the ability for TPG to really take on the big players. So not only didn't they stop. Not only did they stop the merger in the name of improving competition, they absolutely smashed the competition. Right. So it's crazy. Since then, he's gone, and the business hasn't done well since then.
Right.
So you look at their return on equity; it's 4.3, so it's miserable. We're showing a return of about -5% per year at the current price, and it's currently on a PE of 18. Which is at the bottom end of the range for them, but their earnings growth is showing average of -18% over the last 6 years. Now they took a big hit from 2020 with COVID, but they're the kind of business you wouldn't expect to have taken a big hit through COVID. So I don't understand that, and I haven't followed it since to understand why. Right. It's coming back up, but it's still nowhere near the pre-COVID levels. So I'd just pass.
Rudy?
Yeah, I was surprised. I was curious how Teaminvest, because I know it was one of their favorite stocks in the past. I have a slightly different view. I think Theo left. It's a little bit with the same with very famous sporting people. Some of them know when to leave, and some of them don't. And I think it probably speaks to him that he saw the writing on the wall, and he thought, "I better leave a positive legacy here." I think it's very simple. I think sectors like telecommunications sometimes go through phases where the young challenger brands have all the momentum going for them, and that makes whoever sits at those companies at the helm makes them heroes. But sectors change, dynamics change, and ultimately you end up with the market leader that fights back and solidifies its position. I've said a couple of times, Telstra is making a comeback. I think in that sector, I think Telstra is the way to go. Analysts are now forecasting pretty much a gradual improvement in Telstra's fortunes, which is something new since listing, because it hasn't happened that often in the past. If you also take into account, and I think this reporting season is showing that as well, companies that are going through a tough phase, they don't necessarily come up with the recovery because the economic circumstances are getting tougher. And the last thing you want is having your company turn around when the economic circumstances are getting more of a challenge. So I think for companies like TPG, who basically have a little bit in a challenging period, if you're sitting there waiting for the turnaround, you might have to be patient for longer.
Right.
And that this reporting season has shown that on many examples. So I personally, if you pay attention to the macro picture, where the economy this year will only get tougher for most companies, then maybe you don't want to sit in companies that have just had a really challenging time and are still. Right. I mean, one thing I picked up this very quickly from TPG is we spoke about cash flow earlier with Tyro. TPG's cash flow is neutral before paying out dividends.
Right.
And they will pay out dividends because we're listed on the ASX, which basically means their cash flow will be negative. Everything they pay out in dividends will eat in their cash flow, which is also a situation where you don't want to be in eternally. So it's opened up the risk spectrum, and I wouldn't. I mean, you can invest your money with less risk in the Australian share market. So go for less risk because times might get tougher.
So you think Telstra is a better bet than TPG?
Oh yes, right, definitely.
Okay.
All the risks with cash flow and dividends, you don't have that with Telstra at the moment.
Okay. All right, next stock, Scott wants a view, Rudi, on Eagers Automotive, the biggest listed car dealership. Nick Polites is the biggest shareholder. Done well out of it.
Very popular with parts of the investment community. Also, they're also a steady dividend payer as well. Their performance to date is stronger for longer, but I still have my question marks. I mean, they are. In a nutshell, they've been one of the beneficiaries of the COVID and lockdowns. That momentum is continuing today, but you will just have to question, like, at one point, does that momentum slow down a little bit, and that will almost by definition then translate into a much lower share price. And you can see that we have a little bit of a rally there on the back of this month's results, which surprised to the upside. Again, I'd rather probably not be there. And go with companies that have less question marks.
Because there's obviously the supply chain catch up of new cars that that pent up demand that COVID put the mockers on, so they've been a beneficiary of that. Matt, what do you think about this?
I totally agree with that. Interestingly, if you look at their the earnings over time, for the period from 2013 to 18, it was pretty flat. You know, so it wasn't an exciting company at all. It's had a very good COVID. I agree with Rudi.
They've bought automotive holdings, huh?
Yep, that's right. But their sales, their earnings, looking at their earnings chart, their sales are about showing about where they were pre-COVID, but the earnings are still significantly higher. That's not a good sign. So it means that they've been making super profits because of the shortage of stock and so on. That won't last.
Right.
Which means it's got to come back. So I would pass.
Okay.
But it's not a bad company, you know.
No, but the margins are right. You're
right. Kim Mark wants a view on Treasury Wine Estates, Australia's biggest wine producer. Of course, Penfolds is its most famous brand, but a whole bunch of others got hit for six when the trade war started with China. They pivoted. It's sort of talk that maybe the door is not opening, is sort of there's a crack in the door to get back into China.
Yes, it does seem that way until we say something else that offends them. But I think the problem with these things is any business that has a reliance on a government or bureaucracy or political structure, it's just an extra risk that you don't really want. In my view. But anyway, you'd say that that's already in. now because they've already suffered it. But the problem with Treasury is since 2019, and it really has been the China woes.
Yes.
And then I'm not arguing that. You could say it wasn't their fault. Okay, fine.
Yeah.
The returns are pretty mediocre, and we're showing a returning about 1.7% a year over the next 5 years, which is less than inflation. So, how could you get excited about it?
Yeah.
The PE is currently 28, which on an EPS growth rate of -1% at the moment. And let's say it comes back, sure, but it's not cheap for the price. So the market's been, I think, fairly generous in maintaining a high PE ratio. I think the market's expecting them to do better.
Right.
That's probably but it's in there already.
Right. So it's built in, so you've missed the boat. If you want to get
it doesn't interest me. I think there's better lower risk, better probability investments.
Okay, so you look at that chart, and
that's Mark and that's you.
Yeah. No, the Treasury wider stage chart. But the Eagers one, before you said it, had already had a good run, and you wouldn't get in it, and you see it coming back. If you're an Eagers shareholder, would you get out at these levels? It's not far off a 5 year.
Yeah, well, I would.
Treasury's nowhere near it.
No, I would, because of what Mark and I have discussed earlier.
Yeah.
They still have basically had extraordinary margins coming out of the COVID period with all the restrictions. At some point, those margins will normalise, and then you get a much lower share price.
So sell into this rally.
I think so.
Yeah. So Treasury wine estate.
Treasury wine is a little bit
really.
Yeah, it is different.
It's a little bit different. It's a little bit different because I'm a little bit less negative than Mark is. Right. I think this has been one of the great growth stories in the Australian share market until, unfortunately, China said we're gonna get back at Australia, which is. I personally would prefer that they don't move back into China because they're doing great stuff in getting their wines now in Europe and in the US elsewhere, which is a much more solid business. Unfortunately, that's not my choice. It's not their choice. China might be reopening again, and this is why the share price is now where it is. I mean, it has recovered quite. The market is already taking a punt on. They might be one of the beneficiaries, and that's why. So basically, if you want to buy now. You almost by definition have to take a punt that China will open and that they will get some volume into China. The share price will go higher, but unfortunately, if that takes longer or it doesn't happen, the share price will go lower. Right. That's unfortunately the binary proposition now. If you take a longer term view though, and now I'd like to get rid of the China perspective, if you give it some years, because the commodity wines they have, the commoditized wines, the cheaper ones, it's only 20% of the business, Yeah. Oh no, it's actually, it's more, but it's only 20% of the profits. So it's the small part of the business that basically makes 80% of the profits, and those are the wines we like to have at $1,000, $2,000, That's the business, that's the business that will take the share price over time much higher.
Right.
But you get these China related and other things in between.
Okay, all right, so what would you be doing with Treasury?
If I was in it, I would hold it, and I would take a long-term view.
Right.
If I'm not in it, I'll wait for a longer base to come in.
Okay. All right. So
I'm not in it, so I would be waiting.
Right. Okay. All right. Not there. All right. As we mentioned at the top of the show, Tyro reported this morning a pretty good result, and joining us now is the Tyro Chief Executive. Thanks for your time. That's a positive free cash flow. Is that the big takeout from the result, Jonathan?
I think it is one of the big takeouts of the result. I think it's really been driven by three key things. First of all, a focus on growth, focus on profitability, and also a focus on really delivering and driving innovation. The positive free cash flow is a highlight, as is our $1.1 million statutory profit.
Yep. What got you to this position?
Look, I think it's the three things that I spoke about. We've really done a great job in driving growth of the business. We've seen $21.7 billion worth of transaction growth in the first half, which is 37% up on the prior period. We've seen really strong growth in our customer numbers. So we've seen a 9% growth in the number of merchants and customers using our products and services. We continue to really push into our banking side of our business, and we've seen 101% growth in the value of loans originated. And we continue to really push ahead with innovative products and solutions. So I think they're really the key drivers of the outcome.
Are you seeing an increasing competition from the major banks because they really defaulted, a lot of them, except for Commonwealth Bank, the other three of the big four, really left this market to you, didn't they? They didn't see it as a way of holding their small business customers. You're now getting a banking license and benefiting from that relationship you're building with your merchants.
Yeah, look, I think, Koshi, that we certainly do see the competitive landscape changing. The big banks are the areas that we have historically taken market share. Yep. We do see some of the global competitors obviously also having an impact, and we also in the payment space seeing far more competition from local domestic players. But we do see against many of those local and global competitors, our banking license as being a key point of differentiation. It does allow us to be able to provide products and services that differentiate and provide our ability to be able to help merchants effectively manage their cash flow. So while it is a more competitive environment, we think that we're pretty well positioned.
Okay, so the banking part of the business is the future.
Well, the banking part of the business is a key part of our future. We still see really strong growth opportunities in our traditional payment space, where when we look at in-store payments, we only have 6% of the market, and we've been growing at about 6 times market in that space. But we also see further opportunities to really push into banking and to be able to leverage that, to be able to deliver a deeper relationship with the merchants that we support.
Yeah, Jonathan, Mark Moreland from Teaminvest and Rudi Filapek Vandyck from FN Arena are with us here on the panel. Mark, did you have a question for Jonathan Davey?
Yeah, sure, Jonathan. And if I can ask, and I don't know how you can answer this, but what's the vision for the bank? Where would you see Tyro being in, say, 5 years? Or so what's good look like to you?
So look, we really have a focus on delivering the best experience we can for our merchants. If you go back to the history of Tyro, we have been a technology company and an innovation company that really has tried to back businesses and to reimagine what the future of payments and banking looks like. We do see payments in particular changing significantly, and we do think there's some opportunities to be able to really drive product innovation for our customers. Our ambition is to continue to grow at 20% on an annual basis. So that's 20% increase in gross profit on an ongoing basis. And that's really where our vision lies. It's about delivering the best products and services and continuing to deliver value for our shareholders.
Okay.
Jonathan, I quickly picked up this morning from your ASX statement that you were very pleased with your agreement with Telstra, which played a big role in the numbers you reported today. Could you elaborate a little bit more on that agreement and what you think that will generate for you from here onwards?
Yeah, look, I think what we're trying to do here is to be able to provide access to the Tyro products and services via third-party relationships. And historically, Tyro's done a really good job at doing that through our point-of-sale partners. Our partners generate a significant proportion of our ongoing customer acquisition. Telstra is clearly one of the leading retailers and telecommunications companies in Australia, and by partnering with Telstra we have access to about 350 of their retail outlets and their small business centres. It provides us with the ability to partner with a leading partner who can help us distribute our products to market and to really work with small businesses to be able to deliver not only telecommunication services but also payment services. You would have also seen we made some announcements this morning about a similar partnership with Australia Post, which puts us into another 400 Australia Post outlets. So it's really about how we can bring products and services to market via those partners.
Okay, with the technology side, and you're spending a fair bit in that, is Square becoming a bigger competitor for you?
Look, Square is clearly a competitor, and I think that they're doing some really interesting things. What we do find is that Square's playing probably a little bit more at that micro end of the market. Certainly an interesting area for us, an area where we have been historically strong, but we're really trying to be able to make sure that the services that we provide not only deliver value at the micro end of the market, but also into the SME and larger business sector as well.
Yep.
So Square is one of the competitors, but there are also a number of others.
Yeah. With the banking side of it, you were talking about sort of cash flow management for the merchants. What other banking products do you foresee in the next year or two?
Well, we do have a banking license, so we therefore are able to provide a transaction account. We also have a term deposit account. We also, as we mentioned, have our lending product, which is a working cash flow solution. What we need to be able to do is to be able to provide those services to more of our customers. It's actually only 6% of our merchants or of our customers that have actually had a loan with us. So we see some enormous opportunities just to be able to leverage our established customer base with the products that we have.
Yep. And let me tell you, cash flow financing, I think will increase in popularity over the next 12 months, given where the economy is going. You're at the coalface. Are you finding your customers doing it tougher now than they were 12 months ago?
Look, it's interesting, Koshi. I think if you look at the numbers that we've seen in the first half and in the first couple of months of the second half, we are not yet seeing any discernible change in discretionary spend. In our forecast second half, we have built in a softening, but to date, we haven't seen any discernible change.
Because you're getting a lot of anecdotal evidence saying January and February have been terrible, particularly in retail. You're not seeing that in the data that you're processing.
Correct.
Okay, all right, that's fascinating. Jonathan, really appreciate your time. Thanks for joining us.
Pleasure. Okay, thank you.
Jonathan Davey there, the boss of Tyro. There you go.
And by the way, that intel from him on what they're processing is far more reliable than what you read in the papers about everyone going, oh, it's going to be really bad.
Yeah.
Maybe, because he obviously doesn't cover the whole spectrum. It's very specific in what Tyro covers.
Yeah.
And also, as prices increase because of inflation, that obviously eats into, or that adds to the revenue momentum for me.
Because they have tens of thousands of
face
clients.
value payments.
Yeah. Okay.
I think it's a good read. That's a good read for how retail's looking.
Yeah, too right. All right, let's get back to the stocks that we've got on the list to get through. Magellan Financial Group. Mark?
Well, that's an interesting one, isn't it?
Yes, it is.
I'll tell you what, we have spent a lot of time discussing Magellan and Teaminvest, and there are many views on it. There's a lot of lessons in it as well, actually. That's probably another, which is good, because we don't have many bad stocks. When I say bad, I mean investments where they really don't turn out the way you expect them to. It doesn't happen very often. Now, admittedly, we've been in a bull market, but Magellan was really good until it wasn't. And then when Hamish Douglas effectively imploded, now we had him down, we had a major risk of keyman risk with him. Now, usually when we talk keyman risk, we mean, if the CEO goes under the bus or something. But when you have a CEO who is a really high profile figure and that he is the reason, in large part, why funds are attracted to the business, obviously they're a much greater risk if they are not there anymore. Anyway, so he virtually disappeared and went on medical leave. Then they had the loss of their biggest decline in the UK, James Place, which is what I think was nearly 20 billion, 40, something like that. And they knew that was going to happen, by the way. Months and months before, but they didn't know when, because St James Place said that they were changing their strategy from using active fund managers like Magellan to going all in, basically going 90% index funds.
Right.
So they knew it was happening. Now, with hindsight, they would have been far better off if they'd announced that to the market at the time, even though they didn't have to, because it was they were just being advised by their client that eventually you're going to lose the business.
Right.
So the media said it was because of underperformance.
Right.
Which is what the assumption is. You lost a big account. It must be underperformance. It wasn't. That wasn't the reason. Anyway, it was a bit of a perfect storm. So we had major outflow. We also had at the same time the China problems where with Alibaba and so on, and Magellan was heavily invested into those stocks. It's literally a perfect storm. So all the risks that we identified all went off at the same time, and we've never ever seen that in our 14 years.
Right.
So now the question with Magellan is, some of our members have been buying it down at this $8-ish kind of level, because it's got nearly $5 of free cash or cash available outside of their funds. So it's ridiculously low price for the size of the business still.
Okay.
So the business is still very profitable.
So the business is being valued at $2.
Yeah, we'll say $3,
and they've got $5 of cash.
And they've got they've still got 50 billion under management, and they're very, very profitable. So the funds they've lost through this process, which is about 50%, was mainly wholesale, which was the low margin funds. So they've got the retail funds still, largely, which are much higher margin. So their financials are actually quite good still. However, the management has completely changed. It is now a completely different business.
Yep.
You now have a very, very conservative ex-future fund leader, low profile, not charismatic, the exact opposite to Hamish Douglas. So it's a different beast. So you look at it, you go, well, what's it going to be in 5 years? What we look for is we want to be virtually certain that earnings per share will be materially higher in 5 years' time. How can I say that about Magellan?
Right.
I can't. So if you look at it, to me, it's sort of a turnaround story, but it's a really good turnaround story in that it's not losing money. Most turnaround stories are losing money. Yep. This is one that's actually very profitable still. And if they can stabilise it here, and it's sort of looking like there's clues that that's happening, it's very cheap. And it could easily go back to $15, $16 based on the current business as long as it stops the deterioration, the funds outflow. I don't know whether they'll do that, but I suspect they probably will.
So too high risk for you?
Yeah, too hard.
Ready?
Let's throw in a Warren Buffett quote.
Yeah.
Problem with turnaround stories is they seldom turn around.
That's right.
Yeah.
I think the story of Magellan is much simpler. The market went through a phase of pretty much extreme valuations for growth stocks and a complete no attention for anything else. In that period, Magellan looked like they were the best fund manager Australia has ever had.
In the world.
Or in the world even, I mean.
Yep.
And from the moment that dynamic changed, their performance collapsed essentially, which, to be honest, I predicted well before it happened, because it's not Magellan, it's the market essentially. The market changed and Magellan sat there with stocks that all of a sudden were overvalued and not performing. Magellan is not the fund manager that has BHP or CBA in their portfolio. The problem now is, and I'm a little bit less sanguine than Marcus, the problem now is that they've significantly underperformed both in their fund management as in the share price. So how long are retail investors going to be patient with them? Because they also charge relatively high fees.
Yep. And
if they at some point will be forced to cut their fees, that will have a tremendous impact on their profits. I think there's two things stand out here. I think, no doubt, the share price is probably near its lows, where very dangerous statement to make. But it also will by definition require a long time to turn that around, the performance. And the key that needs to happen is that the market needs to stop buying BHP and CBA and start buying CSL and ResMed instead, on a comparable scale.
Right. Yep.
And maybe Tyro. I mean, and if that doesn't happen on a consistent basis, then fund managers like Magellan will find it very difficult. I think there's another scenario, which is probably the reason why you want to hold on to it if you own it. This sector as a whole has been suffering from outflows, and the valuations are relatively low today, both to their own history as to the market in general. So what you see is they start eating each other.
Yeah.
So the best scenario here, and I actually think that is not inconceivable, is that someone will come along and goes, I'll offer a premium to shareholders and I'll just take the business.
Okay.
Totally agree. It's on a 7 PE.
Yeah, there you go.
Okay. So I'll hold for you.
Hold for a takeover offer, and otherwise
I'd say hold if you've got it.
Hold as well.
Be very patient.
Yeah,
all right.
I agree.
Okay, a hold on Magellan and be patient. Simon wants a view, Rudi, on Macquarie Group.
There's a new book out. I heard yesterday.
There is.
So I'm going to buy it and I might read it, because it's obviously a tremendous. It's one of those success stories that we have in Australia, and I think it's not.
Well, the book's been promoted as sort of Australia's Wolf of Wall Street, but doesn't quite deliver that.
Okay. I haven't read it, so I don't know.
There's only a very small allegations there, half a page or something.
I do know a few people who were there at Macquarie, and they do have their war stories to be told. Maybe another time with a few pints of beer with it. I own Macquarie. I haven't always owned it. It appears that I didn't own it. I often blame myself for not owning it. You own it because of the culture they have internally, and because of the ultimately they find a way to deliver. It's that simple. If there's one company on the stock exchange you buy for the culture and for the people, One could be Wesfarmers, the other one is definitely Macquarie.
Okay.
And you just take a longer term view. You don't take any into account. One thing you can do with Macquarie as well is they are very good in sniffing out where the next driver of growth will come from. And they were very early in going into Asia, and they were very early to go into green assets.
Yep.
And they'll and they're
so would you buy at these levels, 185?
I probably wouldn't buy here, but I own it and I have no intention of selling it.
Yep. Okay.
And you buy on weakness.
Mark?
No, I agree. I think Macquarie's a fabulous business, and if you're comparing banks, now they're not, obviously they're nothing like ANZ and Westpac.
No, but they're taking market share.
Yeah. They own home loans even.
And they have, exactly, and they've done the technology investment.
Yeah, they're way better.
Yeah.
And if you look at the returns on Macquarie compound over time, dwarfs the banks, the other banks.
Yeah.
So it is, and I totally agree with Rudi in that they have been really good at innovating and sniffing out the deals and setting themselves up consistently ever since I've been watching it. And I used to own it. I bought it in the GFC for, I think I paid $12 for it in the GFC, something like that. I
remember 15.
Wow.
15, something like that. And then it was when the government guaranteed them.
Yeah.
And I thought, so I put in it and I sold it at 55.
Yeah.
Now my mistake was, and I thought I was pretty clever, I did 400% on it. It's now 188. Now I know better now because there's no reason for me not to keep it. By the way, it's always passed our filters. It doesn't pass the challenge we have with it. It's a complex business. So if you're going to say I want to understand the business and so on, forget it. What you're doing with Macquarie is you're trusting the machine, and it used to be called the Millionaire's Factory because they pay everyone really well for bringing the deals in. You eat what you kill, and it works. Yeah, and they've done it consistently for now 30 years.
Post GFC.
Yes, what's that?
I think 2015 or so.
So would you be buying it?
It's in the middle of the black at the moment for us. So we're showing it returning 13.9 per year at the current level if they continue doing what they're doing, and about 4% on a margin of safety. I like to buy in the green, which would be a PE of 14, and that would be about $163.
Okay.
I'd be happy. I'd be happy to buy it at that. But that's
so you'd hold if
you could buy it now if you wanted to. But it's not a screaming bargain. It's just middle.
Okay. Let's recap the first 5 stocks. Tyro, a no from both. TPG, a no from both Mark and Rudi. Rudi prefers Telstra in the area. Eagles, a no from both. Treasury, the same. Magellan, a hold from both. Be patient. And Macquarie, a hold from both. If it gets to $163, well, then Mark would be interested at buying. Here on the call, we've been following our own fantasy growth portfolio as picked by our investment committee. The most recent committee meeting is up on the website at the moment on the platform. In February, they got out of Aristocrat, JB Hi-Fi. They added Paradigm and New Century Resources. Up the weighting of BHP, CSL and Boss, and since the 1st of March last year, it is up 11.5%. All right, this half hour, we take a look at Tyro. I've spoken to the chief executive already, so I've got Caddy, SQX, Frontier Ventures and Calix to get through. Rudi, got a view on Calix, the technology platform for beverage suppliers?
Caddy.
Yep.
No.
Well, that was short and sweet, Mark.
Okay.
No.
Okay.
I mean, I actually think the least words we spend on this the better. I mean, if you look at the daily volumes, if I give my Sunday money, which I used to give to my sons 10 years ago, if I spend on the market, the share price might double.
Right. Okay.
So completely all you need to know.
Yep. It's actually its market cap is 4 million.
Right.
Now there's a real problem with that because to be listed on the ASX, the frictional costs, you've got to do audits, you've got to pay the ASX. It would be minimum $500,000 a year. What do you have any facts on it? It's a lot. And you've got a 4 million market cap. Explain to me how you can cover that. You have no business being a listed entity with 4 million market cap. Even 100 million I think is tough, but 4 million is a joke. And there's no liquidity at all. Also, the other problem is they've been going since 2014, and like what they're doing is they're investing in technology disruptors and so on, specialising in beverage. Which they've had 8 years? 8 years of history, and all they've been doing is losing money. They've never made a cent ever.
Right.
For 2014, it looks like they broke even.
Okay.
And they're actually losing. It's coming off a cliff since 2020.
Yep.
No.
Not worth looking at.
No.
Anna wants a view, Rudi, on SQX Resources. Recently listed, very recently listed.
Very recently listed.
Exploration company.
Well, it's an investor, my understanding is, but I'm probably going to say the same thing as Mark. I tend to wait 3 or 4 years after their list, because then you get to see their true character. Yes, you'll miss out, if it's a success story from the get-go, you'll miss out on the early gains. But you know what? If it's a great company, there's going to be plenty of time along the way to get on board. And the other thing is that mining industry goes through cycles. So there's no automatic take a long-term view and see the share price appreciate by default. I would basically, again, it's too young, it's too small, it's unproven, you name it. If you're interested, by all means, keep it on your watch list and see what happens over the next 2.5 years and make up your mind.
Yep.
Yes, it's 5 million market cap.
Exactly.
So ditto what we said on the last one, but I'll add to it.
But it's only just come to market.
Yeah, and I'm just reading what the blurb is. Because now, why would you list it? That kind of level. The reason you do it is you want to ultimately access public markets. So you've got a story, and I was reading their story, and it says they've got a tenement called the Scrub Paddock Prospect. That sounds exciting. Anyway, then it comes into like all this story about gold and stuff they've found on a 2-kilometre strike length, and it's like reading a wine label. Where they talk about that, it's got after flavours of leather saddlebags or something. It's like that, and you sort of read it all. And unless you knew what you were reading and really could understand that it's meaningless, so you can guarantee that what they're going to do is be coming and doing capital raisings and so on to get money to then turn the exciting story into a new exciting story. And this sounds to me like a mine the investors' pockets for the next 10 years. Because we've got heaps of them on the ASX that have done it for 10 years or more.
And 5 million market cap really is nothing.
Yep. Okay. All right, let's get on to something a bit bigger.
Rudy could buy the whole thing.
House prices are more expensive in Sydney.
Rudy's house would be worth more than that. Damien wants a view, Mark, on Frontier Digital Ventures. Now, we talk about platform stocks like Seek, like REA, like car sales. Frontier Digital Ventures builds those platforms and starts them and buys into them, but in developing countries. And they've sold a few in the past. What do you think of Frontier?
Well, the problem again is that they're in an exciting area, but they don't make any money. So they've had. If you look how many years, it's not a startup. This has
never been profitable.
It's been going for 7 years, 8 years. Never made a cent.
No, never been profitable.
And so it's like, and they're losing about 3 or 4% a year. So they're not losing a lot. So they probably can keep going for another 10 or 20 years on the capital that shareholders have in there to pay the executives and all the people who are in there. And maybe they'll get lucky and find something really good.
Right.
They might get lucky.
Yeah.
But at the moment, why would you bother? And it's actually the market cap's 270 million, so it's not insignificant. They've got no debt, but look, there's nothing I can say in there that looks worth a discussion.
Rudi?
They're not the first to go into emerging markets with that idea. But the difference with the likes of REA Group Car Sales, Seek and the ones we have, is they have a very strong base at home.
Yeah.
Or at the very least, they operate in economies like the US and Italy and Britain and things like that, which are by all means comparable to Australia. Once you move into things like Indonesia, Malaysia, Pakistan, the risk profile is enormously different.
Sure.
Right? And one of the problem childs, for example, for Frontier is Pakistan. Right? An economy in trouble. If the economy is in trouble, how well are you going to support?
But see, car sales have gone into Mexico and Korea. REA reckons India is going gangbusters for
but
them.
But they start off with
a
very strong home base.
Right.
And for example,
and they've got capital.
For example, REA withdrew from Italy. It didn't work, and they just withdrew, and they still have Australia. And the US for as long as they own it. But the difference with this business is there's no market leadership in an established market from which they can relate to, and from
they've got no bank.
It's all loose sand basically.
Yeah. Okay. All right. Our final stock to have a look at today. Philip wants a view, Rudi, on Calix. Now,
very interesting business.
But it seems to have changed on a dime. I thought Calix was this carbon capture making cement, but then you read it now, it's into battery technology.
Oh, it still does. It still does.
Advanced batteries, more sustainable mineral and chemical processing.
It has broadened the scope, and I think it's an interesting business. But would I buy it? No. You know why? Too small, unproven, not profitable, and you name it. And even the cement project they have, that's a multi-year project. Essentially, so
all these other things they've got into is that
everything is early stage. It's all and this business
to
itself
bring more of a portfolio of products.
And the business itself, it's nice to develop all these things, but it's really a small cap business. So you're going with the flow, or you're falling with the flow, and for me that's not a base to invest. I mean, you want profits, you want growth in profits, you want pricing power. You want all of that. This all is blue sky pie in the sky, and it can all pay off, but you don't need to be there in the early stage. I mean, if they are successful in, let's say, 5 years, then maybe in 6 years you have a great share price to buy, and you keep it for the next decade.
Yep.
Yeah, and interestingly, they've got it, because they're in a sexy area.
Yeah, they are.
Yeah, there's ESG people can buy this. The funds and so on. 890 million market cap. 18 million in revenue, 16.5 million loss.
Yeah,
so they're losing $1 for every dollar they make.
18 million
in revenue and
it's
900
close to a billion
market cap. And you go, hello, what's wrong with this story?
Yeah,
that's a revenue multiple of valuation rather
of 20 times revenue.
Because people buy it on the theme of ESG and carbon capture, but they don't really look at the underlying business, and they don't have no regard for the risks.
Right.
No. And share price moves. That's why you buy it.
Yep. All right, Inema, let me finish with a question to both of you. And I was thinking,
the answer was
depending on time. No, when you're talking about Macquarie.
Yeah.
So we're going into a really uncertain period at the moment.
Yeah.
There's likely to be another big leg down in the market coming up.
Or a big leg up.
Do you stick? Do you have a core bunch of stocks, say in your 20 stocks? There are 10 there that you just love, that deliver the whole time, and just top up those existing stocks when the share price comes down, or are you constantly on the look for new stocks?
No, I'm with you.
In these times.
Yeah, we're in the add to what you know and what's doing well for you. Like T&E, if I can buy T&E at $10, I'll put it whatever cash I've got in.
Right.
Well, the
technology one.
What a performer, huh?
Yeah. That is music to Rudi's ear. Are you still in it?
Of course.
Yeah.
And see, but why would you not be in it? The thing is, we look at it going forward, and I've been in it since 2010. And the original investment I made, I think I've told you, I paid 98 cents. And I was $20,000 worth. That's all I got, because I put an order in for a lot more. But I was really clever, and I put in 98 cents, and it went up to $1, and I didn't buy any more. I was really smart. And that, just interestingly, their EPS has been growing at an average of about 14% a year over that time. And over those, how many years is that? 12 years. Over those 12 years, that $20,000 is $334,000 with dividends reinvested.
Right. Wow.
So it's 130% per year return. Now, what there's probably people don't understand compounding. When I say people, I mean everybody. Very difficult to get your head around it. And you can look at examples and go, it looks like it doesn't make sense, because you see these hockey sticks over time, like Berkshire Hathaway, Buffett's companies, because it's that compound on the earnings and the compounding on that. And that's how much it is. Right. So why would I sell it? So I want to add any time I can buy it on weakness.
Right.
Warren Buffett made a similar comment in his last newsletter, by the way, how he illustrated how the first year when you bought Coca-Cola shares, you had like 75 million or something in dividends, and 10 years later it's 750 million in dividends every year, recurring and growing. And you're right, people don't understand that principle. I mean. Now, coming back to your question, because obviously I'm a long-term shareholder in Technology One as well. I'm a little bit different from Mark. I actually have an active portfolio management approach, but what I do is, if I believe that one of my pet stocks, and I have pretty much an overlap with Mark as well, the Technology Ones, the CSL, etc. If they really, it's very annoying, but it happens, sometimes they can get really overvalued.
Yeah.
I might take some off, but I don't completely sell out because I still have that long-term view that this company in 5 or 7, 10 years time will be a lot higher. So just temporarily, maybe for the next 6 months or so, it might temporarily. And I've learned my lessons, because in the early days when I did this, I would sometimes sell out, for example, out of a certain stock, and then you don't get back in. That's the difficulty, and that's why it's much better to just maybe half your stake or something, and then if you're wrong, you still have half. If you're right, you can buy back at a lower level.
When it goes, because you always say, which a chart show, CSL gets down to 250, 260 virtually.
Well, it was only a few months ago. It was 260. It was 262 a few months ago.
And that's when you top up.
And we've just done quite a lot of work on CSL, and it looks fantastic going forward. What they have in their approved, their pipeline of drugs with V4 or 5-4 is going to be a mega earnings boost. I think CSL is going to really outperform over the next 5-10 years. I say 5-10 years.
Because it's had a ceiling of about 310.
Oh, it doesn't matter about the price. So I'm talking about earnings. Yeah, the earnings of the business are going to be...
Share price will ultimately fall.
It'll catch up.
Okay, fascinating. Let's look at the final 5 stocks that we've had, or 4 stocks really. Caddy a no, SQS Resources a no, Frontier Digital a no, and also Calix a no as well. Mark Moreland from Teaminvest, always great to see you.
Good to see you too,
mate.
Thanks,
Rudy, always good to catch up as well.
Computer said no a lot of times today.
Yes, you did say no a lot of times today. In fact, we don't have
we didn't have any
to go through. No buyers whatsoever.
By Telstra.
But,
no, I wouldn't agree to that.
Right, okay. So we don't even have a unanimous buy today. All right, if you've got any stocks you want me to put to our expert panels, put them in an email to call at ausbiz.com.au or tweet us using the @AusbizTV handle. More of Ausbiz ahead. Don't go away. The Pulse of Sex.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.